On August 28th, about 3 weeks ago, I made a video called This is e.l.f. in Bed, in which I highlighted a few problems I saw for e.l.f. Beauty. And since the close of that day, the stock is down about 25%. Now the main reason for me to make this video was the buyback program that they just initiated. But I have to be honest, this week I did my first initial small buy of e.l.f. Beauty. So let's dive into the stock. Let me explain my fair value after I give you all the issues I'm still seeing with this business, but also the opportunities and my future expectations. And I mean, let's start with the negative that I still see for this business. Because if we look right here, we have the growth, the percentage growth numbers year over year for e.l.f. Beauty. And what we can see that over the last 6 quarters, basically, 5 past quarters, we have seen revenue growth over 70% year over year. Well, in the latest quarter, it was 50%. Now, don't get me wrong, 50% is an amazing figure. 50% year over year growth. I mean, what companies would do for that, I mean, it's unheard of, right? But it is a slowdown, and that's an issue. And I can visualize the reason why that's a problem here. Because we have a last 12-month PE, so a trailing 12-month PE of 55.6. Now, this is quite high, right? But then again, we had amazing growth. However, this is after the sell-off. Remember, this is after the 25% sell-off. We still have a 32.8 forward PE. So that is also still very elevated, especially for a company which is slowing down in growth. Now, if we look ahead, we see for fiscal 2025 or full year 2025, we see estimates that the year-over-year change for revenues will be 29%. For 2026, we see it at 18%. For 27, we see it at 17.5%. Now, it's not like these numbers have been aggressively adjusted down. We can see that right here. I mean, we can see that they are basically flat in their expectations, and the most recent trends have still been going up. Now, for the EPS, we see 10% growth, which, I mean, also not really and again, this number is also not really revised downwards. It is slightly, of course, since the beginning of 2024, but not that much. For 25, I mean, also not really that much taken down. And 27 or 26 and 27, they are still relatively flat. So these are the expectations. Growth slowing down massively, and we still have a 32 forward PE. 33 basically. Now the extent to which this is an actual slowdown can be best visualized here. Because here we can see it per quarter, their growth rates going a few years back, right? So remember, we have 49.99% growth over the last quarter, and we are expected to have 34.3% growth in the coming quarter. So let's check back to which or how far we have to go back before we see those numbers again. So Q4, we had 71%, then we had 85% basically, 76, 76.5, 78, and then 49.3. So Q3 2023, so 6 quarters ago, about 1.5 years ago, we had slightly lower than prior quarter. And the quarter before that, so over almost 2 years ago, they had 33%. So e.l.f. has seen a massive uptick in growth. That's why the stock skyrocketed as much as it has done. And right now it's coming back a bit because we are seeing that growth slow down. And that makes sense, right? That has to happen at some point. And we have seen that slow down in other stocks as well. Now I could go through all the stocks we have seen it in, or I will just show you it like this. What we have here first is e.l.f. Beauty. We see their growth slowing down at quite the pace. Over the last quarter, we have seen it at 0.88%. Then next quarter expected 0.25%, and the quarter thereafter even going negative. Now, e.l.f. Beauty, it was my last video. I did a full analysis of this stock. In the prior quarters coming out of the pandemics, we have seen growth rates of 10 to 20% year over year. So now going negative is a huge, issue for the share price, of course. And we can see that right here as well. It went from $580 to a low of $320. But it's not only e.l.f. Beauty. We have seen Celsius Holdings, a stock that I own as well, and I have covered also on my channel. We can see the slowdown here as well. Now they have some other issues like the Pepsi deal, which is expected to let their revenues go negative year over year by quite an extent before coming back slightly. But they have seen revenue growth over 100%. And they are now going negative. Once again, the share price of Celsius has gone from almost $100 to now the 30 range, the 32 range. Now, we also had PayPal. And although PayPal's issues were not so much with a revenue slowdown, but more so with the transaction margins, we've seen that share or that stock going from $300 to a low of 50. I mean, that's crazy, right? Now, once again, PayPal's also a stock I own. Maybe you can see a theme here. But, I mean, they have been growing at the 8%. They are now recovering, right? So we can see that share price going up again, slowly but steadily. But that one is recovering, although it had that massive drop. Now we also have Lululemon. And Lululemon, once again, they went from well over $500 to now 600 or 265, but it was even as low as the 230s range. Now, Lululemon is also once again a stock I own, but they are known for their growth, and this is massively slowing down with the fears of competition, of relevance, and any issues I see with e.l.f. with the slowdown in revenue growth is reminding me of these stock charts. Okay, so then let's just look at the issues that I see for e.l.f. Now, the first issue I have with the management of this business is that they try to give equity grants to every employee every year. Now, I do like that they are incentivized and that they can increase their net worth in this way. Especially if you've seen the stock, right? Like if people have been working there since 2020, get those equity grants. I mean, they are worth a lot now. But they will also be the first sellers and massively selling at this point. The adjusted SG&A. It went from 39% to 51%. Now this is weighing on margins. Again, not that positive. Then they have the cash flow priorities. And I do think these cash flow priorities are very good. Don't get me wrong. They say that they want to invest in growth initiatives and support strategic extensions. Fine, that's very good. So why do a 500 million buyback program? It makes no sense. The stock is very highly valued. And I will get back to this later on in this video because I have some real issues with it. But let's first discuss the opportunities, right? Because e.l.f. has a lot of opportunities. They are growing rapidly. And it's an incredibly good business after all. And the first thing we can discuss is the international penetration. We can see e.l.f. at 16%, while other major public beauty peers, they are at 70%. So e.l.f. is still able to do a lot of expansion internationally. And well, once again, these are some opportunities. Then we have the costs comparison. e.l.f. Cosmetics, $6.50. Top mass brands, $9.50. Prestige brands, over $20. e.l.f. is really cheap. I think they should stay that way because they have very good margins in this way. And this is one of the strengths they have. It separates them from all the other brands, right? They should stay cheap. I've heard some other channels talk about how e.l.f. they can take pricing basically. They still have pricing power left. I don't think they should use it. I think they should stay very cheap. It's the strength of their business. Then they say they are delivering prestige quality at an accessible price point. And then also their buyout of Naturium. I think that they did this very well. And Naturium is not so much a prestige brand, more mid-market, but they are known to have very, very good products. And that fits right in with e.l.f. Beauty. So that's very good. And when we look at it, they had their last product release or one of their later product releases. It was sold out in 10 days. That's perfect, right? That's what you want to see. Very high demand for their products. And Naturium also recently got their products into Ulta Beauty. So that means they are increasing their distribution and that will help with growth numbers. Now, this is of course a process. It's not done overnight, but it will help. Now, here we see that highlighted from the e.l.f. Beauty earnings release. It's one of their slides from their latest earnings call or their latest earnings presentation. Launched Naturium in Ulta Beauty. But then another thing is that they have, or how they present it, as best in class in creating culturally relevant output. Now, I've seen some of my friends or the female friends that I have, I've seen them show up with e.l.f. Beauty products. And when I ask how did they get to it, what made them buy it, they either said, oh yeah, I saw it online, I saw some things from them, so I was curious about it. Or they say, a friend of mine bought it, they said it was quite good quality, especially for the price, so I wanted to try it out. But best in class in creating culturally relevant output, I think that is really important. Social presence, social media presence is really important and will get only more important, especially with the target audience for e.l.f. Now then we have the unaided awareness, and that is what I was talking about. In 2020 we saw it at 13%, and in 2024 we see it at 33%. So that increase is very positive, of course. That will help with their growth numbers, and it has still the possibility of going a very long way. Now, if we compare that to other brands, we see that e.l.f., and they put the age of the brand underneath it, e.l.f. at 20 years of age at 33%, L'Oreal at 114 years at 39%, CoverGirl 41%, and Maybelline 55%. So they are doing quite well, and especially for the age the brand is. I mean, the brand is only 20 years old. I mean, they will be able to grow this, and that will support their growth numbers. And then we have the shelf expansions in the US. And what we see in spring 24 at CVS, at Boots at Shoppers Drug Market, in the summer at Walmart, and in fall in CVS and Superdrug. So they are expanding shelf space still. This is not a story from the last 2 years. They are still expanding shelf space. Maybe not at the pace they were, but they are still doing so. But now they are also expanding internationally. So what we see is that they get into one retailer or one partner first. In Italy, for example, they had one, I can't remember the name this quickly. In the Netherlands, they had Ethos. Now in Australia, they will have Kohl's. In Mexico, they will go into Sephora. In Germany, they will go into Rossmann. I mean, they do this really well, right? But also the digital consumption, their own website, they saw 40% growth. Now, this can be linked quite good to my review I made about Ulta Beauty, because for Ulta, this is a problem. For e.l.f., it's an opportunity. Now, they are growing this a lot, and of course, if they don't have to use the partners, they don't have to sell it to a store who can then sell it, this means more margin for e.l.f. or being able to offer it even cheaper. So that is really good. And 40% growth year over year, that's quite a big number, right? Now we can see that growth also in this figure. We can see that in Q1 2024 they had a digital penetration of 18%, and in the latest quarter this was 21%. So the increase there is very helpful, of course. Now then they also have their member base, the Beauty Squad, and this is now over 5 million members, with over 30% growth. So 5 million members, that's a good base to start with. It's not a small members program. So, I mean, that's good, right? Those members, they buy more of your products, they have higher average tickets, they have, well, more buys over a certain period on average. Over 5 million members right now, that's good, but it still has a long road of growth ahead of it. But then I do want to highlight one last issue I have with this stock before explaining my valuation and what I expect for the future of this stock. And that is the buyback program. And to highlight that, I first want to look at the balance sheet with you, because we see the cash and cash equivalents. These are 110, 109 million in the latest quarter, while a year ago this was 142 million. We see the accounts receivables being 155 million, while a year ago they were 90 million. I mean, that's not all too great. The inventories is now at almost 200 million versus 98 million last year. A bit of an issue, right? You don't want to see that inventory jump up too quickly. So the issue that I have with $500 million in buybacks is basically their cash flow, their free cash flow. Over full year 2024, fiscal year 2024, they had $62 million in free cash flow. This is simply not a lot, right? This year they are expected to do 83 million. Once again, not a lot. And then the year thereafter, 340 million. So that's a good number. But when we look at the press release, once again, that they had about the $500 million buyback program, then we can see that it says a $25 million buyback program authorized in 2019 was completed following a repurchase of $17 million in stock in the past 2 weeks. Now, this was August 27th, right? The stock was well over $150. It was just coming down from over $200, and they blew 17 million of their 110 million on the buyback program. The stock was trading well over a 35 to 40 forward PE. You don't have that much cash, and you're gonna blow it on buybacks? I mean, in my mind, that's just plain stupid. That's just dumb. And then to initiate a $500 million buyback program, that's just way too big. That's just trying to save the stock. But for what? I mean, the stock is trading at very elevated levels still. Right now, it looks to be more of a fair value, right? So if they are gonna start tapping into the buyback program under $100, completely fine with it. But blowing it over $155, we can see at the statement, the change or the price was $156. I mean, that's kind of bad asset allocation in my opinion. I don't know why you would blow your share repurchase program in 2 weeks. You never used it basically, and then all of a sudden you blow through it in 2 weeks. I think it's bad policy. But that's my opinion. I also think that this really attributed to the sell-off of the stock. I think that analysts saw this, institutions saw this, and they said, okay, we don't like this. Because I don't like this. And they have way more responsibilities than I do. But I think they will get better, right? I don't think they will blow that 500 million. I think they got a bit of a shock of that sell-off in their share price, which, I mean, I can see where it came from. But I also think the stock can still go a bit lower. And let me explain why I think so. Because if we look at the household and personal products, this is basically where e.l.f. falls under. They are also included in this chart. We see a PE ratio, an average PE ratio of 29.4. Now, this is a weighted average, and Procter & Gamble was in this with a 400 billion market cap. The second company was like 80 or so. So, I mean, this is really skewed towards Procter & Gamble, right? But a 29 average PE ratio. Now, e.l.f. is at 55. But they are at a forward PE of 33, right? So that's a big difference there. However, we also have that free cash flow. The free cash flow yield for e.l.f., this is right now, I think it's around 1%. The average for the S&P 500 is 3.2%. So e.l.f. is trading at a third of the free cash flow yield of the S&P 500, right? The PE ratio of the S&P 500 is around the 20 to 22 ratio, and well, e.l.f. is at a 32 forward PE ratio. So, I mean, that's not all too far off. And if we look at it for the full year, I did the small calculation I'll show you here. Analysts have e.l.f. at $3.18 of EPS for this fiscal year. That will mean with a 30 to 35 PE, which I think is quite realistic for e.l.f., a good number. The stock would be anywhere between $95 and $110, right? So basically why it's trading right now, that's more on the high end. However, e.l.f. gives a a mid-range or a midpoint in their guide of $3.38. Well, $3.38.5, very technically. Anyways, this gives a price, a fair value on the 30 to 35 PE ratio scale of $101.55 to $118.48. Now, I think e.l.f. should be able to manage the $3.38. I also think they will be able to manage to up that guide a bit, but we will see how that goes, right? In the last video, I also highlighted how they didn't up their guidance as much as investors might be expecting from e.l.f. So I am curious to see how this progresses throughout the year. Then we have my future expectations for this stock. Now, if we look at their guide, their fiscal 2025 outlook, we see net sales growth of 25 to 27%. So that's low, right? That's quite bad if you compare it to 70s, 50s, 25 to 27. I think I calculated as if it would be stagnant now for the rest of the year, almost. So that's not good. And I don't think that will happen. So this should be increased. Also, if they don't increase it, then we'll have a completely different problem here. The adjusted EBITDA 297 to 301 million. The adjusted EPS 336 to 341. I think they should be able to increase this as well. And the adjusted net income of 198 to 201 million. Now, what we see that analysts have this company doing is for fiscal 25, we see their growth at 29%. So that's slightly above that 25 to 27%. But 29% still is not all too good. We do see the EPS number that's at $3.50. So that's also slightly above the guide that e.l.f. gave, but it's only 10% EPS growth. I mean, that's quite low, right? That's even lower than they had in 2021. That wouldn't be all too good. They should be able to manage to get this higher. But I mean, they really should do. Now, this week we also saw other news, which we will see happening more. And that is that e.l.f. Beauty is maintained at overweight by Piper Sandler. So they still see it as an overweight in their portfolio. But they did cut the price target to $162 from $260. Now that's a very big price cut, right? That's huge. And we will see more of this because the analysts, they have their price targets set quite high. We can also see that right here. We see the average price targets, that's the blue range. We can see that it has been going down quite a bit already. Basically, since the beginning of September, the end of August, beginning of September, it has been coming down from about $224 to now $202. I mean, this will continue to go down. You will get this adjusted. And at some point, the stock will get just overblown by bad news, right? By bad price targets. I mean, we've seen it happen. So there might be a little bit more pain in this, but we do see that rating, that stock rating, going up. Now, 5 is a strong buy, 1 is a strong sell. So even though they have been lowering the price targets, they have been increasing the rating. So that's quite weird how that goes sometimes. But hey, they're analysts, right? So then finally, we have the trailing 12-month quarter-over-quarter revenue growth. Now, we have been seeing this come down slightly over the past 3 quarters, and I think this will go down even further. Now, that's not too much of an issue. It happens all the time. Being at 10%, that's quite good, and I hope they will stay there, but I can see it going down to 8 to 7%. But that would also mean that there will be slightly more pain in this stock. So what did I do? I bought some shares in e.l.f. It is about a 2% weighting in my portfolio for now. So it's nothing major. It's a little more than a watch position, because then I would say it's more like 1% to get it close and to monitor it really well. But still, it's nothing that big. If it goes up, it's fine. It doesn't really, or it won't be that meaningful for my portfolio. But also when it goes down even more, then it will not be that meaningful either. The reason for me to highlight this is that someone commented on my video, one of the recent videos, that they wanted to buy, or they had bought Celsius, but they thought their average was a bit too high at 37. Now, my average for Celsius is 37 as well. But what I did was I bought an initial stake, which was a bit too high, and then just slowly dipped my toes in. I won't go in too fast. So when e.l.f. continues to go down, I will evaluate and maybe buy more. Now, I am very curious. This is what I want to look at in the coming earnings reports, is that cash position and the inventories and that accounts receivables number. That is what I will be focused on really heavily or really strongly, because I think that that will be really important. Because if they are going to break down the balance sheet, that's an issue, right? Just like with the 500 million buyback program, which I explained, they shouldn't be buying back too many shares. If the stock dips under $100, they can. There I will also be a buyer. But for now, they should just leave the stock to it and let it do what it does. I hope you find this video informative or educational. And if you did, make sure to subscribe to my channel, because I release 3 videos a week in which I will explain what I do with my portfolio, but also analyze stocks and give my opinion on what they are doing, their statements, their releases, and earnings. Now, thank you for watching this video, and I hope to see you in my next one.